there on that site. So you will find that it is very useful. And when the time comes when you have some income and you want to make some investments, so I think you'll really enjoy, understanding and using that link. It'll be good. देखिए फाइनेंशियल ये के लिए ना, जैसे तानिया कल पूछ रही थी कि व्हाट हाउ डू वी इन्वेस्ट इन इक्विटी, किस तरह से करेंगे. ठीक है, देयर आर सम बेसिक रूल्स. उस चीज को हम लोग मतलब वी विल डिस्कस दैट. और इसमें ज्यादातर जो रूल्स है ना फॉर स्पेशली इक्विटी इन्वेस्टिंग, दे आर अबाउट थिंग्स यू शुड नॉट डू. कौन सी चीजें ऐसी हैं जो आपको नहीं करना चाहिए. Those are the things which are very clear. जो लोग इस चीज को कर रहे हैं, जो इसमें सक्सेसफुल हैं, they will tell you that don't do this, don't do that. What you should do is also pretty clear. And one thing which comes out very clearly in equity is that you should never try to use equity for the purpose of gambling. अगर आपने उसको एक क्विक रिच मतलब एक स्कीम बना लिया, या इमीडिएटली पैसे कमाने का कोई अगर उसको आप स्कीम बना लेते हैं, देन यू थिंक कि इट्स यूजलेस. यू आर गोइंग टू लूज डेफिनेटली, एंड दैट इज नॉट द पर्पस ऑफ इन्वेस्टिंग इन इक्विटी. सो वी विल गेट टू दैट. लेट्स जस्ट वेट अ लिटिल फॉर आवर फ्रेंड्स टू जॉइन. Okay, Paresh ji is here. Good evening, Paresh ji.
Good evening, sir.
So the three of you are absolutely regular. Very nice. So today's class, we will continue with what we are doing, understanding different types of mutual funds. देखिए mutual funds में basically there are only two parts of this unit. The first part, of course, is to understand what a mutual fund is, what is the governance structure, how it works. Those things are important. That is one. The second part, from the point of view of an investor, is how many types of mutual funds are there and what information is available publicly about these funds. See, the theory part is very simple. We will do that today. I will tell you about each type of fund, what exactly these funds are. We did some of these yesterday. But what will be more interesting today is when we look at a large number of these funds or these different types of funds and look at their actual performance. Look at their net asset values, look at their assets under management, the sort of returns they have had over different periods of time, the portfolios that they have, everything. And that will give you a very, very good idea about what this whole mutual fund is. And it will equip you to make investments in mutual funds in the future in an informed way. You will know how to take a good decision with regard to making an investment. So with that, what I'll do is I will share yesterday's presentation and we will continue with that. So we had, I think we had done. Do you want me to revise anything or should I continue?
Sir, you can continue.
Tanya, Shruti?
Yes, sir, continue.
Continue, na? So let's start, let's go with this. So first of all, there is this concept of multi-cap funds. And we said that they invest in stocks which are listed on the stock exchange. 65% at least should be in equities. they will invest in all, in the small companies. Multi-caps will invest in small companies, big companies, medium companies, all. Large cap, like it says here, ki minimum 80% will be in the large cap companies, and then you have large and mid cap, which will basically combine. And the other thing which we covered this yesterday also. The basic thing about this is that the risk element is less in a large cap and it is higher in a mid cap, highest in the small cap. The reason for that is, like I said yesterday, that in the case of large cap, you are dealing with companies which have a stable revenue. Stable revenue means their products are continuously selling in the market. They are selling their products. Whatever they are doing with their business, they are doing it in a good way. And it is consistent. Consistently, they are earning money. Consistently, they are making profits. Because of that, it is the risk from your as an investor is less. That is the basic logic. In the case of a mid cap, they are also doing all these things, but they have less experience. They have maybe less market share. And to some extent, you can say that they are less stable than the large caps. But this will not always be true. This will not always be true. But broadly speaking, the conception is that in the case of a mid cap, your risk will be slightly higher than that in the case of a large cap. But don't take this as a rule. It is something which normally happens. That's one. Then in the case of small cap, so these are companies where the number of shares floating around in the market and the value of those shares are not very large. These companies probably are a little new to the game, and as a result, they have a smaller body of experience, and therefore there is a chance that their own businesses may not be as stable as the large cap or the mid cap companies. Therefore, the risk in the case of a small cap is considered to be higher. That is the basic logic. Then we talked about this dividend yield fund. So remember, why do we have something called the dividend yield fund? Can anyone recall from what we discussed yesterday?
Yes, sir.
Yes, Shruti?
If a company pays dividend, it will be an add-on for the mutual fund companies to give it back to the investors. That is why if the company is like investing in the companies that give a dividend, it will be beneficial for them and have more profit, more returns.
One reason, okay, fine. But see, if a company is, you are absolutely right. Now tell me one thing, Shruti. Which type of investor will prefer to go for a dividend yield fund? See, this is another thing. Now, when we think about these different types of funds, first of all, we understand what these funds are doing. The second thing to understand is which of these funds is good for us. Now, in the case of a dividend yield fund, since the companies the mutual fund is investing in, these companies are all paying dividends. Therefore, there is a steady revenue coming into the fund from the dividends. And this revenue can be distributed to this revenue basically will increase the NAV. And in a way, a manner of speaking, it can be distributed to the different unit holders, the investors. Now, people who are looking for income from mutual funds, like for example, if you take a retired person who wants to basically invest in mutual funds for the purpose of having a regular income, then a dividend yield fund makes sense for him. So remember, we mentioned something like a value investing, a value investing concept where the mutual fund is investing in companies because it feels that the share prices are undervalued. The market has not recognized these companies, the worth that these companies have, and therefore less people are buying those shares, and therefore the shares are available today at a lower price. So the mutual fund feels that we can buy more of shares of these companies, and the mutual fund also feels that going forward, these companies will do very well, and as a result of that, the share prices will rise and their investors will make a profit. But now, this sort of fund may not be the best choice for a person who is looking for steady income from a mutual fund. Because in the case of that type of fund, there is a waiting period before the company actually begins to do well. And only after that once it begins to do well, people will begin to buy shares in that company, the share prices will rise. And at that point of time, the asset value, the assets under management of this particular value investing mutual fund will also increase. Then it will be good. But for a dividend yield fund, it is not wait, it will not have to wait for the money to come in. The funds, the actual asset values will increase as these dividends are actually paid by the companies. Like we said, this value fund here, what I was just speaking about, this will not make so much sense for a person who is looking for a steady income. The focused fund, so it will have a maximum of 30 stocks in the portfolio. This is one. Then you have the contra fund. Contra means, अगर हिंदी में बोली जाए इसको तो उल्टा, the reverse. What everybody else is doing, I will do the reverse. Now the advantage in that is that when everybody is going in a particular direction, buying shares of particular companies, then the chances are that the shares or prices of those companies will go up. But if I go in the reverse direction and I begin to invest in those companies which are not so popular, then the chances are that the prices of the shares will be low. And so this is also a form of value investing. In a different manner, if you just look at it carefully, the strategy is almost the same as the value investor. Because here also, you are looking at companies which you feel are good. Because the market doesn't think it is good. The investors are not actually, making an attempt to buy shares from these companies, but you feel it is okay. Therefore, you go there. You are going in the opposite direction. So in many respects, it is similar to the value investing fund. So the underlying assumption is that the herd behavior among investors often makes the market very costly or very cheap at times. So that's the concept. Now, the other thing here is debt funds. Now, before we actually go to debt funds, what I want you to do is, I will open a link, and if you can follow the link on the screen, I'll share the screen with you. If you can do that, then there is no problem. But if you find there is a problem with that, then of course, you will have to open it on your own. So I am now going to, let us start with a multi-cap fund. Okay, I'll share the screen with you, and I think that will be okay. Okay, can everyone see this?
Yes, sir.
Yes.
Yes.
Okay, now this is the same link which I had shared with you earlier on. As you can see here, money control, you can see the cursor, no? My cursor, you can see that, no?
Yes, sir.
So moneycontrol.com, mutual funds performance tracker, returns multi-cap fund. Now see here, you have these boxes with multi-cap, large and mid-cap, small cap, ELSS, dividend yield, sectoral, contra, focused, value fund, flexi-cap fund. So if I tap large cap, what will happen is that I will now have all the details of the large cap. Now, similarly, so let us start with, let's say, multi-cap, and then we'll go ahead from there. And I'll show you in each case, which are the major funds, how to use this site, and we'll continue from there. So let's look, we are only looking at equity right now. We are not getting into any other category, only equity. Then we'll go for others. Now, first thing first, which are the funds which are interesting in the equity multi-cap segment? So you can see out here, the first one is Quant Active Growth Fund. Now, CRISIL rank 5. Let's not worry about this part, the CRISIL rank. They have rated it on a number of parameters and they are rating it as 5. So only the top 5 are given. The 5 is not exactly a rank, it is a point which they are giving. So let's say if people have the same number of points, they will have the same rank also. Now look at this. Can someone tell me what this is? AUM?
Asset under management.
Yes. Now look at the amount of assets under management of Quant Active Fund. 1,595 crores. So 1,595 crores is the amount of assets under management. They have bought shares in different companies. We will look at that also shortly. What companies they have bought in and what exactly, not what companies, but how much. Now from here to here are the returns. So look at this. In 1 week, if I look, there is a negative return here, minus 2.19. If I look for 1 month, it is again negative, but it is 0.50. If I look at this for 3 months, it is 1.60. If I look for 6 months, it is 8.56%. If I go year to day, matlab, from today going back exactly 1 month, starting from today, the 30th of January, and going back 1 year from today, 1 year back to 2021, that return for is 0.66%. And the 1 year return is 54.98%. Year to day, this part, this I'll clarify to you later. Year to day. Actually, the 1 year return is this one. And the year to day is a little different. Okay, we'll get to that. Let's leave the year to day out of it for the moment. Let us just look at this. 54.98% is the return for 1 year, exactly, for 12 months. 2 years, it is 46.65. 3 years, it is 34.48. So this is the position of Quant Active Mutual Fund. Now, if I look at the SIP returns, so what is an SIP? Anyone?
Systematic investment plan.
Okay, so what happens in this systematic investment plan?
You have option to pay monthly, quarterly.
Okay.
Fixed amount.
Fixed amount. So, for example, you say that I will buy 100 units every month. So they will keep buying that for you. And you keep buying this. So it is like a bank recurring deposit. Shruti and Tanya, are you understanding this?
Yes, sir.
Tanya?
No, sir.
Okay. So in a bank, there is something called a recurring deposit. You have any idea about that, Tanya?
No, sir.
Okay. Doesn't matter. See, it's like this. Suppose you are getting, let's say, an income of 20,000 rupees and you want to save money.
Okay, sir.
Now, you find that you are in a position to save 1,000 rupees every month. So normally what happens is your expenditures are about 18 to 19,000. You are always managing to save every month about 1,000, 1,200, 1,300, all that. So over a period, last 6-7 months, you find that about every month you have saved that much, and that is lying in your saving fund, in your savings account. There is about roughly 7,000 in your saving account.
Yes,
Because
sir.
every month you are working for 6 months. Last 6 months, every month you have saved a little over 1,000. Today there is 7,000 in your saving fund account, and you now decide that you want to invest, save in a more, let's say, planned way. So how will you save money in a planned and disciplined way? So what you can do is, one option is you go to a bank and you open what is called a recurring deposit. Now, a recurring deposit, what the bank will tell you is that you think of any installment that you want to pay every month. How much money can you save every month? So you say that I can save 1,000 rupees every month. Fine. So every month, what the bank will do is they will take 1,000 rupees from your account and they will put it into a different account called a recurring deposit account, which will have a higher rate of interest. Understand, Tanya?
Yes, sir, understanding.
So now what will happen is they will ask you for how many months do you want to do this? You will have to choose some period. So you say that I want to do it for 1 year. So what will happen is for next 12 months, every month the bank will take 1,000 from you. So totally you will naturally save 12,000 on your own. And they will give you a rate of interest which is higher than the rate of interest which you would have got if you had kept the money in your savings account. Okay. Now, in a bank, the rate of interest will, for a 1 year deposit, recurring deposit, nowadays will not be more than 5%. So you may feel that this is pretty low. I'm getting just 5%. So I want to get a higher return. So suppose somebody says that, look, you can do the same thing. But instead of putting that monthly amount in a bank, put it in a mutual fund. The mutual fund will buy equity shares, and the equity shares over a period of time will give you a better return than the recurring deposit at the bank. Just a minute, guys. This one. Okay, so somebody says that, look, you can do the same thing. Instead of making that monthly deposit in a bank, do it in a mutual fund. Now, the mutual fund, when you ask them, do you have a scheme which is similar to that of the bank? They will tell you, yes, it is called an SIP, a systematic investment plan. How much do you want to invest? And you tell them that, okay, fine, I want to invest 1,000 rupees every month. What they will do is they will take that 1,000 and they will give you units of the mutual fund in return. Units means think of it like a share of the mutual fund. So we talked about NAV yesterday, remember?
Yes, sir.
So NAV is the price of a unit in the mutual fund. Unit, you just remember that unit is a share of a mutual fund. So they will give you these units at a certain price. Now, once you get that, so every month with your 1,000 rupees, they will buy a certain number of units and give it to you. Okay, here you are. These units are for you. Now, over a period of time, this return 1,000 per month will give you a certain return. Now, if you had done this 1 year ago, Tanya, you would have earned this return, 17.61%, as against 5% in the bank. If you had maintained it for 2 years, you would have got 66.57%.
So that means it's just triple the amount of recurring debt.
But The only problem is that the recurring deposit 5%, which they told you, was guaranteed and it was risk-free. Unless the bank actually collapsed, you would have got back your money. There's no problem, you will get that 5%. But in the case of this particular return of 17.61% or this return here of 66%, it depends on the way the market moves. It depends on the way the share prices of those companies in which this mutual fund has invested, it moves. So if those share prices do well, the mutual fund does well. Therefore, the NAV goes up and you end up making a good return. So this is the concept. Is this clear to Shruti and Tanya? Paresh ji, of course, understands this well.
Yes, sir.
Yes, sir.
Fine. So here is your assets under management, the number of shares in different companies, which this particular fund has, Quant, is 1595 crores. Now, let us look at the number of companies in which they have invested. So look at this. Their investment is 98% in equity. They have invested in 50 companies. And they have 1.73 of amount which is lying in cash. That will keep fluctuating. So basically it's like 100% investment in equity. The category of fund that we are looking at right now is equity, mid-cap equity. So see, they have invested in our presentation, we had said that at least 80% should be going into equity. See, this person here has 98% in equity. They have 50 stocks in the portfolio. Can all of you see this, please?
Yes, sir.
So they have taken the money and they have put it in 50 different companies. So that, that entire portfolio of 50 companies, if the shares of these companies do well, then they give you a good growth. If the shares do not do well, then in that case, they will not give you such a good growth. This is one thing to remember. Now, the other aspect here is that let us look at the NAV also. Now, look at the NAV here. The NAV, assets under management, is the same, 1595, which you are seeing every time. The NAV of this particular mutual fund unit, one unit costs 412 rupees. It's a huge amount for a mutual fund. See, normally you will find that other mutual funds, look at this, 170, 20, 75, 78, 146, 238. ICICI Prudential is a very old fund and it is having this 439. Sundaram 228. From here onwards, you see most of the mutual funds which are there, their NAVs are less than 20 rupees. This mutual fund has a very high NAV. It would have begun also at 10 rupees, but it has done so well that the NAV has increased. Now, it will tell you when was the highest NAV in the last 52 weeks. And what was the highest NAV in the last 52 weeks? And the highest it has ever gone in the last 1 year is 437. And when did this happen? It happened on 18th October 21. What is the lowest it has gone? It has gone to 269. This happened on 1st February 21. Now imagine, suppose somebody bought units of this mutual fund on this date, on 1st February 21. He would have bought, let's say he had with him, let's just take an example here. And let's say I have 1 lakh rupees and I buy at this rate. So each unit in the mutual fund company, I am buying at 269 rupees. I have 1 lakh rupees. When I buy this, the company will give me 36,576 units. I have got this. Now, with that money, what I will do is, I will keep it for 1 year. And let's say I get very lucky and I'm able to sell this at, let's say, 400. If I sell it at 400, I will end up with, just a minute, 36,000. Sorry, guys, slight mistake, decimal point slipped. When I bought these shares at 269, these units, I was able to buy 371 shares. If I sell, let us say, at the highest point of 437, I will get back 1,62,000. That means my return will be 62% in a very, very short period between February 21 and October 21. So if somebody is really lucky, he can actually do this. But generally what happens is nobody knows that this is the lowest. Nobody knows that this is the highest. So people are never able to buy at exactly the right time. They are never able to sell at exactly the right time. But theoretically, look where a person can go if he manages to get it correct. So that is one thought to keep in mind. But by now you understand a few things. You understand what assets under management are. You understand what NAV is. So let's look at another fund. Let's take ICICI. This is a very well-known one. ICICI Prudential Multi-Cap Fund Growth. Let us look at this. The NAV here is 439. The highest NAV was 469 in November 21. The lowest NAV was 339 in February 21. Normally, you will find that if one mutual fund has its lowest NAV in February, other mutual funds will also be in either February or January or December. They'll be very close. See, look at this. Most of them seem to be having the lowest in February. 1, 2, 3, 4, 5, then 6, 7, 8, 9, 10, 11. 1st February, for some reason, the share prices would have gone down. And because of that, all these mutual funds ended up with a low NAV. So this is one point here. Now, let us continue understanding ICICI. What are the assets under management? 6,541 crores. And now let's look at the portfolio of ICICI. So ICICI has a portfolio of 84 stocks here. 84 stocks, all equity. 2.40% is lying idle. They are waiting to find the right stock to invest. 84 stocks, 6,500 rupees assets under management. And what is this? What is the returns this company is giving you? Let us look at that aspect. So the 1 year return of ICICI was 33.89%. Okay, so this is how you begin to understand what these different words mean. And ICICI Prudential, by the way, gets the top rank as per pricing. The reason for that, we will have to understand what exactly are the rating criteria which ICICI Prudential, CRISIL has. I'll try to find out and tell you in a later class about this. Meanwhile, let us just understand that on whatever criteria they are using, they are saying that this is one of the best mutual funds you have. We can see that it has a huge, the assets under management are pretty high. We have just looked at the NAV, which is 439. And
Sir,
we also see that.
Sir, I'm not sure. Sir, I'm not sure, but I think 5-star is the top ranking. We have to check, but I think 5-star is the top ranking.
Let me see. Let's see if we can find something about that. Actually, why I disagree with you is that basically what happens is when you say rank, it means it has to start from 1. It cannot go start from 5. What you are talking about is a rating. That is different from ranking. See, the parameters to rate the mutual funds in by CRISIL. So number 1 means number 1, Pareshji. There is no doubt about that part. So basically, superior return score, portfolio concentration analysis, mean return and volatility, quality of assets, exposure to sensitive sectors, liquidity analysis, and tracking error. All these things, they will give a certain weight to each of these criteria. And on that basis, they will come out with a rank. So what they are basically saying is that this is the one which has rank number 1, first rank. Suppose I use this filter here and do it like this. You will see that ICICI, just a minute.
Sir, what I found on Google is that while the top 10% of funds get 5-star rating, 10% of funds are given a 1-star rating. The rating is a composite measure of both return and risk, which help investors.
See, I am also reading from the Yale. It says CRISIL Fund Rank 1 indicates excellent performance, top 10 percentile in any peer group. Next 20 percentile falls under CRISIL Rank 2. But what you are saying is also correct. I think now, basically, both of us are correct. I'll tell you why, Pareshji. See, if you notice now on that page, if we are reading from the same page, the first one is CRISIL rank.
Okay.
Ranks or star ratings to mutual funds at a scale of 1 to 5. So CRISIL fund rank 1 indicates excellent performance. Next percentile falls under CRISIL fund rank 2. But it also has a rating, which is the star rating which you are talking about. In which case, number 5, if it is 5-star, it is the top 10%, and if it is 1, it is the lowest. Okay, chalo, let's not spend too much time on this. We will get back to this. So there is a difference between rating and ranking. That is my point. The 5-star concept is basically, that is a rating thing. If I'm giving someone 5-star, but if I'm giving a rank, the best person will always get rank number 1. That is another thing to remember here. But whether, if this is a star, if like it says star out here, if this is star, then what you are saying is absolutely correct. It is, if it is 5-star, 4-star, if this is the way it is doing it, then yes, you are right. Anyway, it will, this only tells you that the more in depth you get into this now, the more you begin to realize how much information is there and how much more you need to study to get that information correct. So thank you for bringing that to my notice, Pareshji. Thanks a lot. It is something which I think all of us have understood this discussion. And so this is one example. Now let us look at large cap. So if I want to invest in large cap, then what are the funds that I want which are there? So look at this here. DSP Top 100 Equity Fund, Direct Plan Growth. This has assets under management of 2,813 crores. You can see the 1-year returns is 17%, 2 years is 12, 3 years is 15, 11, 5 years is 11%. Canara, Rubico, Blue Chip. If Pareshji is correct, then this has a 5-star rating. It has 23% return, 21% here. Then Blue Chip Fund Growth, 25%. IDBI Top, this has 30%. So see, what is happening here is that we can see very clearly exactly what is the returns these funds are giving over a certain period of time. If we look at the SIP, we can see that SIP's 1 year has been very low, below bank deposits for this fund. 2 years, it has been very good. 3 years, it is very good. 5 years, it is very good. And you see, in each case, that trend is there. 35%, 44%, 54, 33, 41, 53, 30, 41, 59, 35, 42, 53. So for all these funds, you find that those people who have SIPs for a longer period of time, those people are getting a better return. Tanya, this is specific when you ask, should I go for equity or how do I invest in equity? Here is one small fact which you should notice out in this, that when you go for equity, when the length of time is more in large cap, especially, you will find that you will get a fairly good return. So you can see out here that if somebody had an SIP in any of these funds out here, in fact, even those, so right up till this place, you can see that the returns over a 5-year period are very, very high.
Yes, sir.
So this is one lesson which we can learn from the equity part.
Sir, even I can add, if you choose, if you click on this direct plans now,
Huh.
EV and return will change. I think
Yes, it will change.
you will have a better return than
It will have a better return. So can someone tell me why?
because you are not paying brokerage charges.
Yes, because you are not paying brokerage. So here, if we take only direct plans and we take, let us say 38% is here. If I go for regular, so that is another thing which we need to remember. This is something which we had touched upon yesterday in the presentation also, that when we go for direct plans, the expense ratio will come down. Because you don't pay, expense from your point of view, you will not pay I shouldn't say expense ratio will come down, but it's probably better to say that you will pay no brokerage because you are investing directly without coming through an intermediary. And as a result of that, you will do well. So that is one. The only problem with a direct plan, like I said, is that you will have to make this selection yourself. So you will have to decide that I want to actually invest in this DSP, let's say, go to the website and directly invest in DSP without going through any broker or something. So that is one disadvantage in my mind, because you will not get any assistance in the process of selection. If we look at the portfolios of these different returns of these different large cap funds, you will see that all of them have invested in, most have invested in, I think, more than 50 companies. Can we say that safely? So, no, I won't say that most have gone over 50. Probably if I say most have gone over 25, it is correct. But a large proportion of these have gone and invested in more than 50 companies. So basically, when we say that when I invest in mutual funds, I get the benefit of diversification. This is what we are actually trying to say. Because the money that you are putting in the mutual fund, it is not being invested in one single company, but it is actually being invested in a large number of companies. And because of that, you are actually getting the benefit of diversification. If one or two companies don't do well, the other companies do well, then they will still make up for whatever loss was there in those two companies. So that advantage is there when you go for this. Now, there is one more thing here, turnover ratio. What is this? Anyone? So basically, turnover ratio simply means that if I keep selling the shares in some companies and replacing them with shares of other companies. So there is a turnover. I'm selling some of the shares that I have, buying shares in new companies, selling again, buying again. So I keep churning the portfolio. This is another word which is used, churning. Churning means basically to keep rotating. And so you can see that 56% turnover is here. That means the total amount of change which has occurred in their in the companies which they had in their portfolio was 56%. So the number remains 28, but they keep moving between different companies. Here 43%, here 14, here 35%. Another thing which you can see very clearly is that it is all the investing is done in equity, which basically means that there is a risk here, definitely, because you are in equity. And it also tells you that, is there anything else which we can get out here? Some companies have a small amount in debt in bonds. So you can see that IDBI India top, it has about 0.02% in bonds. If you look at Edelweiss, it has about 2% in bonds here. And most of them, as you can see, are very small percentages in bonds, which they have. So this tells you something about the portfolio. Coming back to NAV, so we can see that the NAV is here, 300 rupees for DSP, 406 for Kotak Blue Chip, 42 for IDBI India, 45 for Canara, Edelweiss has 58, GM has 106. So this NAV, and you can also see the amount of funds these people are actually managing. So you can see that which is the largest one here. Nippon India C has more than 11,000 crores. SBI Blue Chip Fund has 31,000 crores, which they are. So SBI has managed, I think, to leverage the fact that it is a bank, it has branches, it has managed to convince more of its customers, I think, to buy mutual funds. Mirae Asset Large Cap Fund, 31,000. ICICI Prudential, once again, the advantage of a bank, 30,000. Aditya Birla, 21,000. So these are those funds which are very big. So big also means that a larger number of people have placed their faith in these funds, and they have, let's say, trusted the fund manager to give them a good return. And we have also seen that what sort of returns the fund manager has given them. And now we can look at, let's take this contra fund. So this was a different type of fund that we had thought of, where you are investing against the market. What do we have here? So obviously a very small number of funds which are star ranked funds, only 3. And in fact, there are only 3 funds, I think, which they are giving. SBI Contra, which has an NAV of 212. Let us look at the returns of this particular. So as you can see out here, it says very clearly what this fund is doing. These mutual funds invest in stocks and follow a strategy of purchasing and selling in contrast to the prevailing sentiment. The underlying assumption is that herd behavior among investors often makes the market very costly or very cheap at times. So if everybody is buying a particular type of, let's say, stock, then that means that those stocks, the prices are going to be very high. There will be a different set of stocks where the prices will be low. And if those companies which have low stock prices do well in the future, then everybody will begin to buy their shares, their prices will shoot up. And if you had bought these shares when the prices were low, you will make a profit. That is the basic concept. How much profit have they made? Let us look at that. So as you can see, if you look at 1 year, 2 year, and 3 year, 1 year is particularly good. They have done very well in the last 1 year, 44.95%. If you go for 2 years, it is still very good, 37. 3 years is also good, 26. And 5 years is 17. So these are some of the different funds which are available. So what this means is, I'm hoping that by looking at these, you are getting an idea about 2 or 3 things very clearly in your mind. What are the types of funds which are there? in terms of a class, like for example, we say that large cap, mid cap, large and mid cap, dividend yield, all these are there. Let's have a look at dividend yield also, since we had discussed this a little before we got into this part of the discussion. So here, if you can see, dividend yield funds. So we don't have too many here. They also seem to have done quite well over the last 1 year. Let's also have a look at this focused fund and see what's happening in this. In focused fund, remember we said that they restrict the number of stocks in the portfolios to a maximum of 30. Let us see if this is true. Let's go to their portfolio here and see what we find. It is not always true. Some of them, I think, have gone more than above 30 also, but very few. Most of them, I think, are broadly following that rule of staying within 30. So basically, in a focused fund, what is happening is that your diversification is less than, say, a large cap fund or a mid cap fund, because as we have seen there, the number of stocks are sometimes more than 100, definitely above 50. But here, as you can see, some of them have only 21. The lowest, I think, is 11. This JM Core 11 fund, the name itself is Core 11 fund. So basically what they're telling you is that we will focus on only 11 companies and we will try to ensure that we get that correct. So if these 11 companies do very well, then we'll do well. Let us see how JM has actually done. Let's see the return of how has JM performed. So JM, as you can see, has not done so well. So maybe this concept of, investing in very few companies has not proved to be very effective for JM Core 11. As you can see, these other focused funds here also have not done as well as the simple large cap, mid cap funds, etc., where we saw that these same returns here were much, much higher. So this tells you something about where you should invest and where you should not invest. At least it's pretty clear, even over a 5-year period, if you look at all these returns, it is telling you what sort of a return you can expect from these funds. So basically, when we look at these figures and spend a few hours looking at them and trying to narrow down what we actually need, it makes our decision in some respects a little easier. And in some respects, your decision will become more difficult because there may be many options which will look equally good. But whether if they are all equally good options and ultimately you simply rely on let's say, your luck to just pick one, it will still be on the basis of some solid information that you have about the way these funds have actually behaved in the past. That is the basic point I'm trying to make out here. So we'll stop this sharing for the moment and we'll get back to this after a short break. It's about 7 o'clock now, so we'll come back in 5 minutes and then we'll look at debt funds and continue from there. I'm hoping that what we did just now, this has given you an idea about what mutual funds are, how you can get information about these mutual funds, and how how all that information can help you to make an informed decision about in which mutual fund to actually go for. I have certainly learned something today, which Paresh ji pointed out, regarding the way CRISIL is using those for 1 star to 5 star. So see, the process of learning will continue always. And it's good that we discussed this. So all of you also understand that. And so let's just take a 5-minute break and we will then come back. Is that okay?
Yes, sir.
Okay, fine.
Yes, sir.
Yeah.
Okay, everyone is here, no? All of you are here?
Yes.
Yes, sir.
So we will continue. We will now go to the next segment, which is the debt fund. So the structure will be the same. We will look at the debt funds. We will then look at the site which we did look at right now. Have a look at what performance is there in debt funds, whether they are better, whether they are they're supposed to be safer generally. So that is there. There is also an issue with tax. So generally, equity funds will generally the tax which you are required to pay will be higher than in the case of a debt fund. Let us just go back to this. Okay, so debt funds, first thing to remember, of course, is that the risk is generally lower as compared to the equity oriented schemes. Can someone tell me why? Nobody wants to attempt that question?
No, because investment in debt, no, not in equity.
Ha. Okay. So in debt, what is the main advantage as far as security is concerned?
Returns are guaranteed.
The whatever
You will not
return is
lose
there, that is
capital.
guaranteed, and the maturity amount is also guaranteed.
Right.
So that is one very big advantage. So in the medium term, very low uncertainty, stable returns. It is generally positioned as a medium to long term investment. So if you have some time with you, then you can go for this. In fact, this is also true for equity. If you really want to get a good return, you have to be prepared to be there for some time. There are tailor-made products for every type of risk requirement and cash flow requirement, short-term plan, monthly income plan, floating rate plans. So for example, you have an overnight fund investing in overnight securities having a maturity of 1 day. Just imagine. So basically what will happen is that they will invest in the last day before maturity, and the next day they will get the full amount from the from whoever issued the fund. Liquid fund investing in a debt and money market securities having a maturity of up to 91 days. Now, this term here, which is there, money market, can someone tell me what this is? This concept of money market? Shruti, very quiet today.
Money market is like secondary market, like I don't know.
No, okay.
Is it like a Bajaj Finance and all that?
No. That is NBFC.
Okay.
Not like that. See, money market basic. Also, tell me one thing. What market is this? The one we are actually investing in equity and all these different companies operating, all the shares which we keep talking about. Buying and selling shares, buying and selling bonds. What market is that?
Equity market.
No, that is capital
market.
Capital.
That is the capital market. So everything which you do on the stock exchange, that market is the capital market. Now the money market is a wholesale market for wholesale transactions. So here individuals do not participate, institutions participate. So it is basically government bonds are sold. So the transaction level here will be in hundreds of crores. And maybe not always hundreds, but just to give you a sense, it is going to be in crores. So 10 crores, 20 crores, like that. So one bank buying bonds or selling bonds to another bank. One RBI selling bonds to a bank giving bonds to RBI. All the transactions which are taking place here one of the biggest instruments which will be there will be bonds issued by the government. So that is one thing, main feature out here. The other thing about a money market is that it has complete liquidity. That means on any day, the bonds which you have can be sold at the whatever is the rate available. And huge amounts of bonds, even if you have, let's say you have 500 crores of bonds, you want to sell it in one day, you will be able to sell it. Because there will always be other institutional buyers available in the money market who will be able to come out with that type of money and actually buy the bonds that you are selling. So, for your point of view, you should remember two things. Number one, it is a wholesale market. Number two, it is a short term market for short term funds mostly. The instruments may be long term. So, there is no contradiction here. The trading will take place on short-term basis, but the instruments that are there will be government bonds issued for maybe 15 years, 20 years, that is there. But everybody, for example, if you have a bank, banks are required to purchase a certain amount of government bonds mandatorily. Like if a bank mobilizes 100 crores of rupees as deposits, saving funds and fixed deposits and recurring deposits and everything, out of these 100 crores, almost 20 crores has to be used for purchasing government bonds. So the bank will buy the government bonds. If fresh bonds have been issued by the government, it can buy that, or it can simply buy in the money market. It can just go there and buy bonds which are available in the money market. Somebody is selling bonds. Some other bank has extra bonds. It is selling it. The bank can simply go there and buy the bonds there. So that is money market. Now, some of the other types of public sector units, they issue bonds. Those are also sometimes listed here. State governments issue securities. That is listed there. So since these are all bonds of one type or the other, having different maturities, they are basically debt. Basically, they are all debt. And a liquid fund is allowed to invest in those bonds also. So basically, it is investing in these bonds, making a big investment there. Like we saw that the assets under management of many of these funds are in thousands of crores. So out of 1,000 crores, let's say it decides I will buy government bonds worth 500 crores. Fine, it will do that. And the quality of the bond is not in question. There is no risk at all. And the liquidity is also not in question because it can be sold anytime. Like I told you, in the money market, it is possible to sell immediately. So that is one. Then there is the ultra short duration fund investing in debt and money market securities having a maturity of 3 to 6 months. That means they will only be dealing with bonds which are going to mature in the next 6 months. Up to 6 months, some bonds are maturing. They will only go for those. Low duration fund. So 6 to 12 months. So bonds which are maturing in the period 6 to 12 months. Money market fund. So this is basically investing in debt and money market securities having a maturity up to 1 year. Basically, the what is interesting here is, what is happening is that the mutual fund, the debt fund is choosing instruments based on their maturity. And if the instrument is close to maturity, one thing is very clear, that the day it matures, that entire money will come to the, will be available to the, or let's say will be paid by the issuer of the instrument. If it's Government of India will make that payment on the day it matures. So they will not even have to sell. They will immediately get the money the day it matures. So these are basically debt funds which are short duration. It may not be the best investment for us. May not be, because we may not be looking for very short duration investments. But it makes a lot of sense for corporates. So many corporates may want to, they have some money lying 100, 200, 300 crores for a short period of time. They don't know how exactly to use that money at that point of time. So these people can actually use these debt funds in a very nice way. They can put their money there, and then the moment they need the money back, they will take it out of the fund immediately. And in the process, it is possible that they will end up making a small return, which is maybe a little higher than what the bank could have given them over the same period. So that this sort of investment normally will not be there for individuals. It doesn't make so much sense for individuals to do this. It is better for corporates or companies to make investment in this sort of thing. So this again continues: short duration fund, medium duration fund. As you can see, the maturities keep on increasing. Medium to long term duration fund, and long duration fund, 7 years. Dynamic investing in debt and money market securities having a maturity across duration. So while the funds which we saw earlier were confining themselves to certain maturities, 6 to 12 months, 12 months to 2 years, here what is happening is they will have a mix. All sorts of maturities will be there. Corporate bond fund. So companies also issue bonds for the purpose of getting money from the public. And here, these corporate funds are also traded on the capital market. These are not in the money market. These are available in the capital market. So mutual funds can go for these bonds also, these corporate bonds. So one is, let's say, the money market government bond. The other is the corporate bond. Credit risk funds, funds investing minimum 65% in corporate bonds having let's say the highest rated instruments. Banking and PSU funds investing minimum 80% in debt instruments of banks and PSUs only. So they are investing, they are very specific. There are bonds issued by banks. So these funds are interested in basically investing in those particular bonds. That is that. There is the gilt fund. So G-Secs, what is G-Secs? Can anyone tell me? Fund investing minimum 80% in G-Secs. What is G-Sec?
Government securities?
Yes, Shruti. So government securities means bonds issued by the government of India. So these will be available where? In which market? Capital market or money market?
Money market.
Yes. So any bond which is issued by the government or the state government, or even some of the, let's say even some corporate bonds are listed there in the money market. So this is called a gilt fund. It is called a gilt fund mainly because gilt normally indicates safety. So the return is not going to be high, but it is going to be very, very safe. There is no chance you will lose your capital in any of these funds. So that is one. Then gilt fund with a 10-year duration, floater fund, funds investing minimum 65% in floating rate instruments. So let us look at, before we go into this, let us look at the performance of some of the debt funds. So we will go here and we will choose debt. Now here you can see we have lots of examples of these funds. Let us take some particular. Let's take this first, the corporate bond fund. Let's see what we have here. So we have, as you can see, a large number of mutual funds available. And you can see very, very different from equity, the sort of returns which you are getting here. Look at the returns here, 5%, 7%, 8%, 7%, like that. And there is another thing, if you look at these top performers here, you will find that there are, for any given period of time, there is hardly any red, any loss. The growth may be less, but there is growth across all periods. 1 week, 0.02. See, very few cases, very few reds. Most of it is green. So that is the thing about a debt fund. The normal feeling that we have is that it is less volatile. It will give you a low return, but it will give you some return. So that we can see very clearly out here. If we look at the 1 year in the case of debt fund, 1 year, probably you will find that it is lower than what you would have earned in a bank. 2 years, what you are getting is more than what you would have earned in a bank. 3 years, definitely more than a bank. 5 years, again, more than a bank. But 1 year, as it happens, you are getting a very low return in the 1 year part here, as you can all see. If we look at, let's say, some other aspect here, let's say the portfolio, how many bonds they have in their portfolio, we'll get an idea. So, number of instruments in the portfolio, 16, 71, 169. So very well diversified, as you can see. Very well diversified. You can also see that they do not have equity at all. So, and another interesting thing here is that the cash holding is quite large in all cases. I don't have the technical knowledge to tell you why this is so high, but one thing which we all know is that if you are keeping 14% in cash, you are earning nothing on this. And all of them are having more, you can just say that it's more than 3% in all cases. Mostly it seems to be 4 above and above, but many of them have, see, 8% here, 14 here, 14, 7, 25% lying in cash. It's a little hard to understand why this is happening, but it gives you an idea. And if you look at the NAVs, that will also give us some more idea about what sort of NAVs these different debt plans have. NAVs, as you can see, are not very high, which is to be expected since their returns are so low. So 62 rupees, 38, 26, 24, 49, 15. This I don't understand at all why it is so high. There doesn't seem to be a particular reason for this. 90, 12, 14. I think let's try another type of fund. Let's take a liquid fund. NAVs of liquid funds, as you can see, are very high. Thousands of rupees for 1 unit of the fund. Like I told you, liquid funds are not basically the preferred type of investment for, what shall I say, individuals. These are mostly for corporates. They are, and that is why probably the NAVs are like this. If you look at the sort of returns they are giving you, we can look at that also. Returns as expected are very low for these. So the purpose of, see, you must understand one thing, that different funds have different objectives. In a liquid fund, the main objective is protection of capital and liquidity at the same time. So a corporate has a large amount of cash. It is willing to park that cash in a liquid fund for a short period of time. What the corporate wants is that you give me a small amount of interest, keep my capital safe, and give me complete liquidity. Whenever I want to get that entire big chunk of money back from you, I should be able to sell it and get it back. So that is what you have here. As you can see that for any period, there is no red. So even if a corporate parked 100 crores for 1 week, it was getting a 0.07% return. This is, I think, the main advantage. For any maturity, any period of time, you are getting something. There is no concept of not getting it. Many times when a company takes some money and puts it in a liquid fund, it does not know exactly when it will need the money. It puts the money there, and then maybe after 2 weeks, suddenly it finds that it has to get the money back, because now it has some other use for that money. So if during that period, on a very large amount of money, if they are able to earn 0.07%, I would say it is not bad. It's okay. And this sort of 3.4% for a 1 year period and all, obviously very few companies will be there which will want to park money for this long period of time. Let us look at some other category also. Let's try this long duration fund and see what we are getting here. So obviously long duration funds are not doing so well, except if you go above 3 years. But in the short term, no one seems to have done well at all. Long-term bond fund. You can also see that the assets under management for these two funds which are there are also not very high. Only 693 crores in the case of ICICI Prudential, and only 1898 crores for Nippon India Nivesh Lakshya Fund. So let's see another thing here, whether they have, what is the portfolio like? See, you can also see one more thing here. There's a number of instruments in the portfolio also are very less, 11, 4, as compared with the other funds which we were looking at, which had so many more of these. Let's try a short duration fund and see what is happening there. So you see the diversification here is much higher. Also very interesting is that the cash holdings are very high out here. Percentage of debt is 70, 93, 93. So mostly it is in debt. That is very clear. And the returns, let's have a look at this. So the short duration funds have a return which is, so broadly speaking, what we can see is that whether you look at it from the point of view of a liquid fund or a short duration fund, mostly the returns are in this range only, between 4 and 7%. But the other aspect is that it is always positive. And I think this is why when we say that debt tends to be less risky, you expect that for any given maturity period, you're going to have your capital will be protected. So when we say that it is less risky, it means that your capital is not at risk. You are going to make some money. So we can see out here, whether you invested for 1 week or you invested for 5 years, in any case, you would have made some money. It follows the traditional pattern. As the maturity period increases, the rate of interest also tends to increase. The returns, sorry, tend to increase. So that is generally there in the case of debt. So we can confirm that particular idea that we have in our mind, that debt is, let's say, less risky than equity. So that is one. Now, any questions so far on this? Anybody?
No, sir.
Sir, one question.
Yes.
How
okay.
come these company have a 180% of holdings in debt and equity?
I don't know. I can't figure that out. I don't know what exactly they're doing. We'll have to go exactly what they have done out there. That means that the amount which is there in the debt portfolio is more than the amount which they have under management. The only assumption can be that they are mixing up funds. They have funds from other, other investments. Some of that money is coming here. That is the only thing I can think of. So, but that point was there. I saw that also. That's not there at all. Under what circumstances? But those are things which are more of an accounting, issue. We should not get involved with how they are presenting those stuff. What interests us is what sort of a portfolio do you have? What return are you offering? What are the funds that are available to us over a period of time? Which funds have done better than other funds? You can also think in terms of the CRISIL ranking there. Which of them are the starred funds? Which of them are not starred? All these things are there. Available information is available with you, which you can use when you want to invest. That is the basic idea. Now, to continue our discussion with about these funds, so we come to fixed maturity plans. So this is the industry's version of a fixed deposit. So these are basically closed-ended mutual funds investing in debt investments, which are held till a synchronized maturity timeline. So a 91-day FMP will invest in debt instruments that mature before 91 days. So we have seen this in the case of the debt, the simple debt funds also, the liquid funds and short duration funds, etc., where they will choose instruments of a particular maturity or instruments which are maturing within a particular timeline. So in this particular case, they are choosing instruments. Let's say if you take a 91-day FMP, it means that they will take instruments which are maturing within that 91-day period. What it also means that it is going to be very secure, because in those 91 days, they will be able to get that money back directly from the issuer of the bond. We can quickly look at the return that they are offering out here. So if we go back here, you can see that fixed maturity plan is here. So if you look at this, we can quickly see what return this fixed maturity plan is giving the investor. So see, it's pretty good. You can see that over any period, in fact, this is the best return we have seen as far as this category is concerned. Look at this. In fact, for a debt fund, they have managed to give a 20% return in 1 year. And the surprising thing is that in this entire page, there is not a single maturity in which there has been a loss. I think, see, this is a learning for me also, that I have never seen a page like this, in which there is no red at all. So you can see that this is another category of fund which is normally not, people don't talk about these funds so much, but here you have, and see another very interesting thing. The assets under management of these funds are very small. 74 crores, 127 crores, 112 crores, 81 crores, like that. They invest, let us have a look at the portfolio. So diversification is also pretty good. You take this one, SBI Debt Fund, 25 instruments. That means they have 25 types of different debt instruments in their portfolio. 89% is in debt, 10% is in cash. So it's pretty clear. 70% in debt, 30% in cash. 93% in debt, 7% in cash. So they are investing very clearly in debt as advertised. They said that they'll invest in debt, they're investing there. What is the NAV here? Look at the NAV, all of you. See, this is the reason why you do not have so many people investing in this. The per unit cost here is 5,76,000. 10,32,000. 11,76,000. Very interesting. And from here onwards, you're having slightly lower, and some, of course, are the. So let's say that, Shruti, you invest in this 10 at 10.45, and let's say you invested in this 1 year ago. What is the return you would have got? At 10.45, it is very possible that you would have been able to buy it. And if you stayed with it for 1 year, so where is SBI? SBI fixed maturity plan. This is not there for 1 year. These apparently were very short maturity plans, which, so we said these are fixed maturity plans. No? So these were short. None of them is 1 year old. So that's it. That is another thing which we can see out here, that these are very short maturity things. Here you have an HDFC August 13, 1846-day plan, which has given good returns over the 1 year period, 2 year period, and 3 year period. And what is the NAV of this? The NAV here is ₹21, 1,434. So Shruti, if you had invested in this last year, you would have ended up with a 8 to 9% return. It would have been pretty safe, and at the same time, you would have got much more than what you would have got in a bank. So as you can see, when we say that debt is not risky, that is correct. We also can see that debt tends to be, it gives you a fairly good return, but many of these available options which are there are not for individuals. They are for people who have, let's say, more liquidity available with them for the purpose of investment. But I think this is the best way of understanding what any particular plan is. So I hope that what we have done today it has helped you to at least understand that if you want to find out about any mutual fund, exactly how to go about finding the fund, how to find out about its performance, how to understand those different words which are there, those different abbreviations which are there, and how to see what performance they have, what NAVs they have. So you know what AUM is, you know what NAV is, you know the different types of funds which are available, and you also know where you can go and find out about the performance, portfolio, SIP returns, annual returns, half-yearly returns, quarterly returns of that fund. So this is again learning for all of us. It can be withdrawn with 1% penalty. And then, of course, there are hybrid funds. So basically what hybrid funds do is, what will a hybrid fund do? Can anyone tell me?
Invest in two different kinds of debts.
No, invest in two different types of two different classes of assets. So it will invest in equity and debt, like that. So invest in a mix of debt securities, convertible securities, and equity and preference shares held in a pre-decided proportion. So the conservative hybrid fund will invest more in debt, 75 to 90% in debt. So here the risk will be lower, and the aggressive hybrid fund will basically invest more in equity. So a dynamic one will keep changing. Sometimes they will have more in equity, less in debt. Sometimes they'll have more in debt and less in equity. In multi-asset allocation, they will have at least 3 asset classes with a minimum allocation of at least 10% in each asset class. Typically, it will be equity, debt, and gold. So arbitrage funds investing on both stocks and bonds with minimum equity investments of 65%, following arbitrage strategy of exploiting the price differential between the cash and the futures markets. That goes beyond our present syllabus of understanding futures markets. So we won't go into that. We will stay with this. So once again, let us have a look at how hybrid funds have been performing. So we can go here to hybrid. And as you can see, the same classification is there: aggressive, conservative, arbitrage, capital protection, equity, dynamic asset allocation, multi-asset allocation, and fixed maturity plan hybrid. So right now, let us just take let's take this multi-asset allocation. This will be the most hybrid of them all. So if we take this, what do we see? We see that they have fairly good returns. This one has good returns. This doesn't have, SBI multi-asset hasn't done that well. ICI has consistently done well for 5 years. So here is a fund which has been doing well for 5 years. If we look at the portfolio of this fund, we can see exactly how much they have in different asset classes. So let's go here. Shruti, that same problem is coming here also.
Yes, sir.
Where we have more than 100%. This is a question which I am not in a position to answer right now, but let us ignore this and look at this. So 72% in equity, 47 stocks are there, 10% in debt, 17 of them are there, and they have invested in other mutual funds, 3.15%. They have a cash holding of 12, and there is unspecified other holding of 1.91. If you look at this particular case here, 75% in equity, only 5% in debt, 13% in other mutual funds. So this is almost like an equity fund, most of these. I think it will be better to look at the conservative hybrid fund, because if you look at this one, though they are calling themselves a hybrid fund, they tend to be keeping more in equity. Now look at this conservative hybrid fund, like we said in the presentation, that these funds tend to keep more money in debt. So we can see out here, the percentage debt holding is almost 74% here, 20% in equity, 2% in cash, 3-4% in other. It could be gold. That is one. Here is another one, 24%, 25% in equity, 62% in debt, 13% cash. Okay. 23% and 71%. So you can see that in a hybrid fund, what they are trying to do is they are basically trying to mix returns and the level of risk. So some part of your money tries to get you a better return at a lower risk, and at a higher risk, sorry, and some of them will give you a lower risk, lower return, like that. How successful have these been? You can see that the best one here is giving you, all of them in fact are giving you good returns if you look from 1 year onwards. So one lesson which we can draw from all these, this entire net surfing that we have done today is that if you are willing to invest for a period, for a longer period, you will generally tend to get a return which is higher than what you would have got in a bank. See, even here, you can see that 10, 10, 10, 14, 14, 14, some of them have done very well. 14% return in a hybrid fund with so much of so lower risk, I think it's very good that way. There are reds here, but the reds are typically in up to the 3-month segment. Beyond this, it is okay. Year to day is, let's forget about that part. We will focus on this part only. Okay, so I think that gives us a good idea about the conservative fund. If you look at the arbitrage funds, how have these people done? Nothing very interesting here. Very, very low returns. And but a large number of options are there for you to choose from if you want to go into this particular area. Okay, so basically, now, when you come to this solution-oriented scheme, this is for, so Paresh ji, this could actually be of some interest to you also, because these are goal-oriented schemes. So, for example, the children's fund, these mutual funds invest in stocks and bonds. Their funds have a lock-in period of 5 years or till the child attains the age of majority, whichever is earlier. So the idea is generally to get a certain sum of money when by the time the child has attained majority. Maybe, you can link it with the time the child goes to college or something like that. Then there are retirement funds, invest in stocks and bonds, have a lock-in period of 5 years or till the retirement age, whichever is earlier. So basically, these are more long-term. And if we look at their performance, we will once again get an idea about how well these have done. So solution-oriented here. If we look, let's say, at retirement fund, how have these are mostly with a lock-in period and all. But as you can see that they have not actually done so well. So if you look at the better funds are here. some of them have definitely been doing well. But since we are talking about long term, one would expect that
HDFC is
5 years.
better. I think
Yes,
ICICI Prudential is better. HDFC Retirement Saving Fund is better.
HDFC Retirement. This one.
Yeah.
This one has done better.
No, 41.16%, sir. HDFC Retirement Saving Fund, equity plan.
This one, 41, 29, and 23 and 18. But see, the problem is, Pareshji, that somebody who is picking from so many funds, it is difficult to decide where you will actually want to put your money. So I would basically be guided by consistency. So I think this fund which you have mentioned seems to have consistently done better than the other funds over a certain period of time. Now, what is the NAV of this fund? If we look at that, that will also give us some idea.
$719, 77. Okay, 26, sir.
This one. This was the equity plan, 26. And so basically, both of these would be the same, more or less. Both are investing in equity. So 31 or 26, they're doing quite well actually in that way. So if, and how well has it done on an SIP basis? Let us have a look at that also. Somebody, because a retirement plan typically means that you are investing in small installments. So in small installments, 2 years is very good, 3 years is very good, 5 years is very, very good, 51%.
So you are looking for a hybrid. Actually, HDFC equity plan is better than that. Second number.
47, 57, 70. Yes, you're right. That HDFC seems to have got this right. They, all of them seem to have done pretty well, all the HDFC ones. And so what is the portfolio like? That will also tell us something. Maybe are they going more for equity, more for debt? How exactly are they doing? So see, it is entirely equity. Almost entirely equity. Debt is quite low actually. Your HDFC equity plan here has no debt at all. So basically what they are doing is that since you are investing money for a longer period of time, and so they are taking a bet on equity, because normally equity investments over a longer period of time tend to be, you tend to do better with those. Equity in the short term tends to be more risky. Equity in the long term tends to be a little safer. So there is whatever volatility is there tends to even out over a certain period of time. So that way I would say that this category, but like you can see, if you look at the returns, not all of them have been doing very well. But over a 1 year period, for example, if you look at some of these, the 3% in 1 year, 5%, 7%, even up to 2 years. If we look at 3 years and above, we are at least getting 11, 8, 10, 8, 8, 7, 10, 9. Then your HDFC alone is giving you this very fantastic return of 23 and 18. Another HDFC one is again giving 17 and 15. 16 and 14 is Tata. And Nippon India Retirement Fund is 13 and 11. Tata Retirement again giving you a fairly good return. So the lesson here is that it is possible to do well with these plans also. But you will have to choose the right fund, which is not an easy thing. Not an easy thing to do for the simple reason that you cannot know in advance how a fund is going to do in the future. So that is one problem there. Coming back to our presentation, let us see what we have left here. So then, of course, you have these index funds. My particular favorite is this. If you ask me, if I wanted to invest today, in fact, I am in the process of just started a small SIP in an index fund. Mainly because in these cases, what they do is they invest in a set of portfolios which tends to mirror the proportion of the index. So the index gives a certain weight to different companies. And for example, the Sensex would be having its 30 companies. It will give a certain weight to them. There will be others which will track the Nifty. So the Nifty 50 will be the basis. So whatever is the exact weight of each company in Nifty, this fund will try to create the same weights for itself and invest in the same way as the Nifty has given the weights. And in that way, they will try to match the return of the Nifty itself. So what you can do is, in the remaining time, what we can maybe do is have a look at the index funds, which, like I said, this is a particular favorite of mine. So let's also look at So if you look at, for example, you can see here DSP equal Nifty 50. If you look at these and you look at this part here, you will find that consistently they have been doing pretty well. And so 1 year, 2 years, 3 years, even 5-year returns, all are double digits. So the point to remember is that if I am getting double digits and in double digits of, why did that happen? If I am getting double digits, then basically it means that I am getting a very, very good return. So like I said, this is a personal favorite of mine. And the reason for that is that it tends to be very safe. And over a long periods of time, you'll always find that the index tends to do better than most companies. So the market as a whole, the index tracks the market as a whole. So that tends to do better than individual companies. Some companies will do much better. Most will not do as good. So when a fund basically goes with tracking the index, there is less for the fund manager to do as such. The fund manager can basically rely on just making sure that everything else works out well. So I think that brings us to the end of today's session. We have almost completed mutual funds. We'll just go for a quick recap next time and then move on to the next topic, which is equity. And if there are any questions with regard to this, of course, you're welcome. Anybody wants to ask anything regarding this. But what I will strongly recommend is that all of you please note that whenever you want to invest in a mutual fund, this is the best way to do it. To first get all the information which you can get on these different funds, understand what is actually happening, and then make an informed decision. That way it will be easier. And there are less chances of going wrong. So remember, the benchmark is always the bank rate. If you can do better than what the bank is giving you, you have already done well. It is not getting the best that is something which you should never aim for, because that is like, winning the lottery. Finding that exact fund which will give you 70% return, it will not happen. Nobody knows it's there in the future. But what you can do is, you can definitely hope to get a rate which is better than what the bank is giving you, something which will protect you from inflation, and something which will be respectable, and you will be proud of the decision that you make. So if there are no questions, I think we can end here today, and see all of you next week.
One thing, just send the PDF of insurance in the WhatsApp group, please.
I'll do that. I'll send and we will also have a small quiz on insurance next Saturday. Huh?
Okay.
Is that okay? I have not sent the insurance one. I'll send that. And this mutual fund one also I can send to you, because I don't think there is anything. A few more slides are there, but it doesn't matter. The main part of it is already covered. If during the course of the week you come up with any questions with regard to the mutual funds or anything like that, of course, we will discuss it next week. Okay then? Good night.
Okay, sir. Good night.
Stay safe.